Welcome. This is Rick Durfee with Durfee Law Group, Estate Planning Law Group, and Probate Law Group, here for another exciting session on planned giving together with my colleague.
Hey everybody, I'm Michael Koberline and here with Durfee Law Group as well. We're excited to be here with you to talk today about planned giving. We just wanted to give a shout out to our friends who are here in association with us. We've got Bliss Realty and Grand Canyon Title who have helped us out to make this a possibility. So thanks to them.
Thank you very much, and welcome to all that are listening live or that end up listening in the future. Today, we're going to be talking about these strategic charitable gifts, or what is sometimes called planned giving, and we have an exciting outline for today's talk.
So one of the things that we're going to talk about, as we mentioned before, is planned giving, but not everybody knows what exactly that means. So Rick, can you enlighten us on what is planned giving?
Yeah, so for starters, there's a lot of stuff that we own or that we think we own. We think this is ours, and it's really not ours. We're going to give it to the tax man or to charity. That's our choice. And so when we're looking at the big picture, at the overall plan for what's happening with a business, with an estate, with a family, often there are tax dollars that we can let them go to the politician, or we can capture those tax dollars and obtain them for the benefit of enterprises or causes that the family or the individual giver believes in. And so there's this bigger picture of planning with businesses and taxes and estates, where planned giving, a deliberate gift that we do for some strategic purpose, is part of it. But there's also other things, looking at anytime we make a gift to charity. If we're going to give a gift directly to our favorite church or hospital or school or whatever, those kind of direct gifts, those are planned gifts. If we're including in our will or trust or our estate plan a gift when we die, those are planned gifts. And we're going to be looking at family foundations and how those work, and split interest gifts, how those work. But all of these center around some kind of greater purpose. It's not just, I feel moved upon by some noble cause here, so I'm going to stroke a check for a few dollars to the disaster du jour, or to support whatever. It's done deliberately and as part of a bigger plan, and it's connected to other things. And that's the bottom line with the planned giving that makes a huge difference in what we're going to be talking about here.
Okay. Now, with the planned giving, we've heard some talk about split interest gifts, which involve charitable remainder trusts and gift annuities, to name just a few. Can you give us some background and some idea on what split interest gifts are and how people can use them in planned giving?
Yeah, so in fact, I'm going to dive into that here. And I'm going to hit this little button right here. So I want to show some ways that this works. And the easiest way to explain that idea of a split interest gift is in the context of an actual planned gift. So we're going to look at a typical event that triggers someone to become involved in planned giving, which is a pending capital gain on the sale of a highly appreciated asset. And this happens because when we buy an asset, we have the cost, whatever it is, and then hopefully the price goes up. There's appreciation or increase in value, and the difference in that is capital gain. And when we sell that asset, there's a tax on that capital gain, and that tax is deferred until there's a sales event There are special rates for the capital gain, and those rates, by the way, are highly political. They go up and down all the time, depending on the winds of politics. And it's your guess is as good as anybody else's. But what do you think? Are tax rates going up or down? Given the current political environment, what's the direction? What are the politicians telling us? And just saying, if the politicians that appear to be in control of things today, if they do exactly what they say they're going to do, tax rates are going to go up. So when this tax event happens and we sell the asset, we trigger that gain. And the important thing to recognize is that tax is voluntary. So how does planned giving come in? How are we going to avoid that capital gains tax? And this brings us to that question you asked. Well, what is a split interest gift? And I like to point out this, a lot of times if you tell people, hey, you can pay taxes or you can give it to charity, they go, what? No, I don't want to give it to charity. So I call people stuck in that dilemma, the accidental or the involuntary philanthropist. They maybe didn't start out with the idea that, oh, I'm going to be a noble human being and give more of my assets to charity. They come kicking and screaming reluctantly to the charitable giving table because there's some benefit for them. So here's an idea. If there's this black box and we're going to pour something in, we're going to pour money or assets into this black box. Well, we're going to avoid the capital gains tax. We're going to get tax deductions that help us reduce our current income tax. We're going to have an income stream that gives us a tax-advantaged income for the rest of our life. And oh, by the way, it's going to generate tax-free money for our heirs, which means we're avoiding estate taxes. And to get all these benefits, the downside we have to live with is that it's going to fund our charitable intent. My question is, do we care what's in the little black box? And what's in the little black box here is charity and life insurance. So let's illustrate this with specifically what is a split interest gift. I had to lay that foundation, Mike, to answer your question. It was a great question. Thank you. But here we go, the split interest gift. Now, if you have an asset, you can divide that asset up in lots of ways. You can put a fence down the middle of a piece of property and the east side is yours and the west side is mine. We can divide it up over time. I own it, but I'm going to lease it to you, so you get to have all the rights of ownership for a term of the lease. I can keep it for life, and you can get something when I'm dead. So with a split interest gift, we're going to divide this asset up into two pieces, the income piece and the residue of what's left over at the end of the income term. And that income term can be for life or it can be for a term of years. So typically, now there's variations on this thing, but in the most common split interest gifts, typically you or the donor, whoever's involved in the transaction, is going to keep the income piece for the rest of their life. And the remainder, whatever's left over, isn't going to go to charity until death. So this is the split. We split it and we divide it up and we keep something and we give something away. Well, because we're giving something away, oh, by the way, that if it's going to go to a charity, it might as well go to your family foundation. And we're going to talk about that in some more detail here in a little bit. But if we're going to give something away, we're going to get a tax deduction. And this can either be done as an annuity or as a trust. So the charitable gift annuity or the charitable remainder trust. And let me just comment briefly, the gift annuity, the distinction there is that's typically an income stream that's fixed at the point of origin. There's no ongoing management responsibilities. You just do your personal tax returns. You have no market risk. You just get a check in the mail. The trust approach, you are in the market, so you have market risk, but you also have the market benefits, and you have ongoing reporting, tax reporting, and accounting responsibilities. Candidly, the annuity approach tends to be favored by older, risk-averse people, and the trust approach tends to be favored by younger, risk-tolerant people who think that they're going to do well in the market. And that's something we can work through. And then how do you provide for your family through a private contractual alternative to replace the asset that's ultimately going to charity when you pass away? So That's the split interest gift in a nutshell, Mike. And now we segue into this thing here.
Well, so the biggest difference between a charitable remainder trust or a charitable annuity is the control and risk. You have more control but more risk with the trust, and then with the annuity you have not as much control but no risk.
Yeah.
Would you
yes.
say it that way?
The annuity, you just get a check. And you know what the amount is that's established at the beginning when you set it up. Hey, I'm going to get a check for X, and it's going to come every month or quarterly or annually, however you set it up. And that check's never going to vary. It's going to be the same. It's going to happen till the day. It's an annuity. So that's what it is. Mm-hmm. With the trust, on the other hand, and so let's talk through this with the trust or with the annuity, either one. You form this trust, and you're going to gift your highly appreciated asset to this trust. And when you gift it to the trust, remember, you're not gifting the entire thing. You're only gifting part of it to charity because you're retaining the income interest. So your tax deduction will be less than the full value. And I recently ran an illustration for somebody that was only in their 40s. And the tax deduction came out to about 19% of the total value. So it's pretty low. For most people in their 60s, it's going to be 30%-ish. The older you get, the bigger the deduction. If you're in your 80s, you can get 60, 70% deduction on that gift. So you transfer that asset into the trust. And by the way, the donor, you can be the trustee of that trust. And sometimes people want to be their own trustee. Sometimes they don't. They'll outsource that to the end charity or to an intermediate trustee or to an independent trustee. There's several options there. But then the trustee is going to sell that asset. So a classic example is the family farm. Grandpa has the family farm. The city grew around the farm, and now the farm's in the middle of the city. And suddenly that those cotton fields or citrus groves that were really inexpensive in the 1950s when Grandpa bought them are now worth gajillions of dollars. All that gain built in. Grandpa doesn't want to pay the gain. So he gifts the orchard or the citrus orchard or the cotton farm into the CRT or part of it. And then the CRT sells it. And when it sells it, if Grandpa sold it, there would be a gain on that tax. Well, in this instance, that sale is happening by a charitable entity. The charitable remainder trust is charitable. So there's no tax on the gain. So the charitable trust then gets all the proceeds of that sale held in the name of the trust and invests them. And we'll typically work with Grandpa's investment advisor, whoever that is, the RIA or the stockbroker or financial planner or whatever, whoever's Grandpa's working with, or the bank or the whatever. And they will invest the money, and Grandpa gets to set the investment policy. This is how aggressive, this is how risk tolerant, risk averse. And then that CRT will pay typically a fixed percentage. So, and that percentage, there's some rules on that. There's a floor and a ceiling. It has to be at least 5%. And the ceiling is going to be a function of the age of the donor. Younger people have a very low ceiling. The older you are, the higher the ceiling. So but you set that rate when you form the trust, and it pays that income out again for either a term of years or for Grandpa's life. So that money is in the trust, is in the market, and you have market risk. And if the market is good to you and you have good investment advisors and you make really smart investment decisions, in theory, the value can go up and your income can go up over time. I have seen situations, however, where people invested foolishly or poorly. They bought investments that declined in value, or the percentage they were drawing out was so high that they were chewing into their principal, and eventually the principal's depleted and their income goes away. So there is market risk on that trust, but you have the control.
Mm-hmm. And in that scenario, you were going to start talking about, or at least I thought with the presentation, it said family foundation. In that scenario that you're talking about, that process, the charity that you're talking about can be a family foundation.
Yes, and I want to give a couple of different angles on this foundation here. Let me pull this up. The Family Foundation. Oh, so let me get to this screen right here. Here we go. Uh, there's different types of foundations, and I got all this text on the screen, but there's different types. You can have a private foundation. There's some things called support organizations, advised foundations, and fiscal sponsorships. And each of those do different things. And we want to get the right fit for your particular needs. Most of the time in this presentation, just for brevity's sake, we're going to be talking about advised funds. And a couple of reasons for that. They're the simplest and easiest to create. They're the least expensive, and you get the most advantages. So you form this foundation. When you put money into it, whatever you put into it, you get an immediate tax deduction for that. Depending on the type of foundation we have up there above, sometimes you are limited. You can only use up to, you can apply that deduction against up to 60% of your adjusted gross income, if it's depending on the nature of the gift. Sometimes there's variations on that. But any unused deduction you can roll forward. You can have that foundation invest the funds indefinitely, and particularly if it's an advised fund, it can go on forever, and your children and grandchildren can run it. If it's a private foundation, the statutory goal of private foundations is for them to expire. They go away eventually, although that doesn't always happen. But they compel you to manage or to distribute 5% of the assets every year. So their goal is in 20 years, you've distributed 5% and it'll be gone. Again, because you have investment proceeds, that doesn't always happen. You get to decide who manages the money. In the advised approach, you can use your money managers generally, depending on who the sponsor is for the advised fund. And then you can make grants out of that to charities of your choice. The advised funds tend to cost the least. The private foundations cost the most. These advised funds, or any variety of these foundations, can be and will normally be exempt from your creditors. With the advised fund, you have a lot more privacy. It's harder for people to find you or know who you are if you want. With the in terms of control and oversight, you have more direct control with a private foundation. But if you don't care who signs the checks, you can do all the fun stuff and choose how things are invested and choose how the charitable funds are ultimately used with an advised fund. And then you'll see up here in the corner, we've got Legacy Global in here. Part of the reason why I promote them is they are very, very good at coming up with charitable solutions that fit the donor's needs, and they will take alternative assets where a lot of the other advised funds won't. And with a private foundation, I'll mention you have excise taxes on portfolio earnings and reduced tax deductions. But with the advised funds, there are no such excise taxes or limits on the deductions. So who needs these foundations? Well, if you just flat out have charitable intent, they work for you. If you are a high net worth individual, if you're doing any kind of the planned giving things we're talking about here today, they're very valuable. I will also say the Family Foundation is a fantastic and very powerful device for next generation training. If you're a high net worth individual and you're thinking, oh, my kids are at risk of getting messed up by my wealth, and I don't have confidence that they will understand how to build it and grow it and preserve it like I did. They'll spend it and consume it and do silly things with it perfectly well, but that makes me uncomfortable. The Family Foundation can be a powerful tool for helping train them so they figure out how money and wealth ought to be handled. So it's great. And by the way, that's a planned giving tool to use for next generation training. And then, of course, if you have no children or if you're disinheriting your children, the Family Foundation makes sense. And then the last one I'll mention here is these bundled deductions. This is a fun and clever thing that's come up recently because of the most recent tax law changes. And this is something that people sometimes know intellectually, but the practical consequences haven't sunk in yet. Currently, the individual exemption on your income taxes is so high that fewer and fewer people are deducting. So if your charitable contributions are less than your individual deduction, it makes no sense to itemize. So giving to charity doesn't increase your charitable deductions. So what a lot of people are doing is using these advised family foundations, these donor advised funds, to bundle their contributions. So instead of making $10,000 a year gifts, which with the individual deduction or individual exemption, you can't really deduct, they'll make a big gift in 1 year, 50 grand or 100 grand all at once. Then they itemize and they get that deduction. And then they spoon it out $10,000 a year to their church or their hospital or whatever their charity of choice is. So that bundled deduction is a very cool thing. So here's the bottom line though with the Family Foundation, and this is something for you to think about. If you just flat out give money to a charity, any charity, your church, your hospital, your school, they're going to say thank you. They'll be very appreciative, and they will, in fact, for the most part, use it for the charitable purposes that they advertise. But then they're going to say next year, well, what have you done for me lately? That was last year. This is this year. I need another gift. So they're going to come back to you with their hand out over and over and over again. And once you give the money away to the end user foundation, your ability to influence what happens with it is gone. So if the charity gets hijacked or derailed or goes off track and stops doing what they were originally doing, you have no recourse. You gave the money to them. It's their gift. It's a completed gift. If you have a family foundation as an intermediary in that scenario, by the way, well, the funds now are in your foundation, and you can still spoon them out to your charity, but you can hold your charity accountable to your wishes and your goals. So I want to illustrate this with an example. Some years ago, I had a client who she passed away, and she had set up an advised fund, one of these family foundations as an advised fund. And this advised fund was supporting a woman's shelter. And this was a woman's shelter that my client had volunteered time at, had personally been very involved with the staff and was really on board with the mission. Well, after my client died, this woman's shelter got into trouble financially and was taken over by a hospital. And the hospital did what everyone would agree were good things. They brought in more money, they expanded the campus, built more buildings, hired more new staff, expanded services, and including medical care, and including, in this particular instance, family planning or abortion services for women who were in this shelter. Now, my client, who was dead, was deeply religious, and I get it. Other people may disagree with this, but her sentiment was that was just unacceptable to her. And so when this woman's shelter changed its direction and started doing something that was not in alignment with the charitable wishes of my client, her children, who were still advising the fund, came and said, hey, this is not what mom would want anymore. What can we do? And the answer was, well, they were at liberty to find then an alternative women's shelter that was more in keeping with their particular values. And I get this could go the other direction just as well. But they were able to, in fact, find another women's shelter. And now the charitable grants each year go to the shelter that's in line with their family. So the point of this is not one set of values versus another. The point is the family had an ongoing voice in how the charitable funds were used so they could hold the charity accountable to their desires and wishes. So that charitable foundation gives that planning control. I'm going to throw up another screen here. I want to point out something with donor advised funds in particular. So with your family foundation, I love Legacy Global Foundation. You get tax deductible contributions when they go in. The funds can be invested and can grow over time. You get to use your money managers. You're not locked into theirs. A lot of the commercial providers of donor advised funds, you have to use their money managers or their platform. Legacy is open, and you can make grants to any charity you want to. So again, a pitch for Legacy. They cost less and you get better tax deductions. So that's my preferred vendor to help people set up these family foundations. Which, by the way, when we're doing that split interest gift that we talked about a minute ago, and you saw on the screen here, let me pull that screen back up. When you saw the end charity here, we're going to come back and throw this up. So you saw the split interest gift developing here as it splits in the residue and it goes to a charity, and that charity can be your foundation. There you go. If you're going to give the money to charity anyway, again, have it be your foundation. Have it be your family that gets to have a voice in how the charitable funds are used over time. And that's becomes something we call social capital. And in estate planning, especially for high net worth individuals, there's the family capital. That's the money the family gets to use and spend and enjoy, and that they get to buy houses and boats and take vacations with and send their children to private school or whatever. And then there's social capital, which is not spent for lifestyle for the family, but it is still a very powerful tool that the family can employ to support social causes in their neighborhoods and communities that benefit them.
We had talked about something that you referred to as program funds, I believe. And is that's something that is in this category as well? Can you touch on that?
Yeah. In fact, I'm going to come back to this screen here. When we talk about types of foundations, you'll see up there the foundation types: private support, advised, and fiscal sponsorships. And some organizations, including Legacy, sometimes call these fiscal sponsorships a program fund. And let me describe what this is. With an advised fund, you as the donor have an ongoing right to say, charity A today, charity B tomorrow. Here's my 3 charities. Now I want to take 2 of those off, and I've got 5 charities and they're different than before. So you can continually update and change your charities, and you can advise that. And you can in fact say, you know, the financial advisor I was using suddenly got weird on me. I want a new one, so I want to change advisors. You can do all that with an advice, and you can advise, and that those advisory rights are ongoing. With a fiscal sponsorship, you don't have those ongoing advisory rights. But what you do have is the ability to custom design a particular charitable purpose. So it might be a scholarship fund. It might be planting trees in deforested areas. It might be some social cause, an orphanage or a hospital or something. Or it might be, in fact, we've seen some lately that are matching funds or to encourage other people to give. There's a great variety of things that can be done with a fiscal sponsorship. But you set this up and you define the charitable plan, the charitable goals up front. You say, this is the mission, and then that's the mission. You don't get to come back and say, I changed my mind, I want a different charitable mission. So you don't have those ongoing advisory rights. Now, the advantage of these fiscal sponsorships is this. Certain contributions are not permitted to an advised fund or to a private foundation. And I'll give you 2 examples. One is there's right now, if you have an IRA and you are taking required minimum distributions, there's something called a qualified charitable distribution. You can give up to $100,000 out of your IRA to a qualified charity, and that counts as your required minimum distribution. So you don't have to take the money personally. So this is great for people who they're going to tithe anyway. So if they're already going to pay tithing to their church or to give it away to charity anyway, It's great for people who don't need the money and that would rather have it go to charity than come to themselves, or that again don't have kids and they're saying, well, I don't need this money and I don't want to pay the taxes when I get it, and I don't have kids that I'm trying to rescue, so why don't I give it to charity? So you can give it to charity. Well, you can't do that with a donor advised fund, and you can't do it with a private foundation, but you can do it with a fiscal sponsorship. So this is something, again, Legacy has been very amazing in working with donors. Well, what do you want to support? Let's design a fiscal program that meets your needs, or piggyback onto others, because there's a lot of them out there. And sometimes people say, well, yeah, I like that one. Let's do that one thing. So that $100,000 qualified charitable distribution can come into a fiscal sponsorship. The other thing that fiscal sponsorships qualify for right now, this will now date this presentation, but we're in 2020 and we're dealing with COVID, and there have been some special dispensations in some of the COVID relief packages, including this year, if you make a gift to qualified charities, you can apply the deduction for up to 100% of your adjusted gross income instead of the 60% limitation. You don't get that again if it's a gift to a donor advised fund or a private foundation. You do get that 100% deduction for gifts to a fiscal sponsorship or a program fund, which is what Legacy sometimes calls it. It's where it's a specific program. Here, we're going to do X with it. And I'll give you an example. There's a number of programs for troubled youth. I'm trying to say this in a polite way. Kids in trouble with the law, and they're in counseling or in some kind of residential treatment center. And often those treatment centers rely on the generosity of good people for their funding so they can stay afloat. Well, there's a number of fiscal sponsorships that are helping those kind of organizations. And so if, hey, I was benefited by that when I was a teenager and I grew up to be a decent human being as a result, so I want to give back to something like that. And I'd like to make that come from my IRA as a qualified charitable distribution. You can run that through a program fund or a fiscal sponsorship, and it works great, whereas you couldn't do it through a donor advised fund.
So that's one of the main things then is with the RMDs from your IRA, you can't distribute those to a DAF or a donor advised fund, but you can with a program fund or a fiscal sponsorship. Is that
Yes.
Yeah. Okay.
The short answer is yes.
I mean, you did a lot of other things than that. That was the thing that stuck out to me was there's a limitation there on the other avenues, whereas with this fiscal sponsorship, that's an additional option.
Right. It's one more tool in the quiver. And this is a lot of times people come and they've kind of got this vague sense of what a family foundation is. And there's not one thing that's a family foundation. There's a great many variations on what that might be. And so we want to help match the right kind of family foundation structure for whatever the donor's needs and goals are. I want to jump back for a minute. We kind of jumped off that capital gains thing. I want to point out kind of a cool thing here, and I'm going to share this screen again with you. When you avoid that capital gain, I want to illustrate an example of this. And we're going to assume, you can see the assumptions there, that we net 5% income, that we had a zero cost basis, that our federal tax rate is 20%. Wouldn't that be nice? Haha. And our state tax rate is 6%, and the 3.8% affordable tax. It's affordable to pay for that, all that affordable health care that we get. And over time, this is what this looks like with a CRT. If you have no CRT, right up front, you're going to pay almost $300,000 in taxes. So you net 700 and some change that you get to invest. You can invest that and you get 35 grand and some change a year. Over 20 years, your income will equal, you'll get back that your $702,000. Well, you'll double it. and you spend it presumably. And then when you die, we're going to assume that $700,000 is you have a taxable estate because you have sufficient assets, or the estate tax threshold is low enough that you qualify, and your heirs are going to net 300 grand and some change. Well, with the CRT, same $1 million right up front. If you're, depending on your age, you're going to get a tax deduction. In our example here, $300,000. That would be less if you're younger, or more if you're older. And your net is the full $1 million, which is invested inside the CRT. And so now your income, instead of $35,000 a year, is 50 grand a year. And out of that $50,000 a year income, we're going to suggest that you take 10 grand of that income, and you're going to apply that to asset replacement life insurance. So then you can see your net, your total income over 20 years is 800 grand. You spend it or pay taxes with it. When you die, there's zero estate taxes. And what do your heirs get? Your heirs get $1 million. And how much do you have in social capital that your heirs, you and your family, can contribute to charity? You have $1 million. So your kids got $1 million tax-free. Your charity gets $1 million. You get more spendable income during your lifetime. And the downside is something had to go to charity. And this comes back to that initial dilemma. There's some things that you think are yours, they're not yours. They really belong to the federal government. And you're either going to give it to the politicians and let them decide what to do with it, or you're going to give it to charity.
The sale of the highly appreciated assets that you talked about a little bit earlier, we talked about some options involving charities and giving some of the money to charities. There are other options as well, and I know that these aren't necessarily having to do with planned giving necessarily, but there are alternatives that you can employ if you would like. And I think, when we have clients come into our office, they always want to know all their options and what they can and can't do. So can we speak a little bit to the sale of highly appreciated assets, maybe talk a little bit about installment notes and 1031 exchanges?
Well, yeah, well, you mentioned two of the biggies right there. And you are right. This kind of planned giving doesn't always work. Sometimes when we do the numbers, it just doesn't fit, or the client just can't get over it. They can't swallow the idea that, something's going to go to charity. I'd rather give it to the politicians than to charities. There's people that have that attitude, and that's okay. Or that they don't care. I don't care if the numbers are better. I'm just not going to do that. Well, okay. So there's other things, and the 1031 exchange is one of them, and that's sometimes called a like-kind exchange. So if you have a commercial property, and this is generally real estate, if you have a commercial property, and there's some technical rules that apply. There's a 45-day period that you have to designate a substitute property or a replacement property. You can sell that highly appreciated property and take your capital out of it and move that capital into another property, and you defer the gain. The gain doesn't go away. It's just deferred. So your cost basis in your replacement property is the same as the cost basis in your original property. Now, there's good news and there's bad news with this. If your estate is below the estate tax threshold, and let's talk about what that is. Currently, that's a high number. It's $11.5 million and some change per individual. So for a married couple, it's $23 million and change. So you could give, if you're married, $23 million to your heirs, and you have no taxes, no estate taxes. Now that number, I need to point out again, is highly political. It changes frequently. It's set to sunset in 2026. The new administration that appears to be coming into power has stated bluntly that they will reduce that if they can. Now, the president acting alone can't do that, at least if we follow the Constitution. So Congress and the legislators have to have a bill and pass the law, and then the president signs it into law. So if we go through that process, that number can change, and it has changed. Again, it's changed frequently in the past, but currently, it's again 23 million and some change for a married couple. So if you're below that, you pay no estate taxes. Here's the other zinger. It's a good zinger that you get currently. If you pass that highly appreciated asset with a low cost basis and the big gain, in fact, let me put the screen up here so that you can see this again. If you pass this, we're going to get this screen here. You've got, oh no, this is not the screen I wanted. Wrong screen. Let me come back to this one here. This is the one I want. Okay. If you pass this asset with this appreciation to your heirs at death, to my knowledge, this is the only advantage to death, at least the only tax advantage. That cost basis, when you die, steps up to the fair market value of the property on the day you die. And by the way, in community property states, you get that twice. You get that when the husband dies, when the wife dies, both times, regardless of the order of death. So that step up in basis is pretty significant. And that is another tax benefit, which, just saying, politicians that appear to be coming into power have said that's obviously unfair. That benefits only rich people. We don't want to let rich people have all the advantages, so we're going to take that away. And we're going to make all those rich people pay those capital gains taxes, even if they keep the property until the day they die. So candidly, that will make the charitable remainder trust a much more attractive option, assuming they don't take away the charitable deductions, because the same people that want to take away the step up in cost basis and reduce the estate tax threshold have also been very aggressive in wanting to take away charitable deductions. But assuming we get one or more of those benefits, we'll have to follow the politics to see what tools remain available. But currently, the laws that are on the books today are when you die, you get that step up in cost basis. So that 1031 exchange, kicking the can down the road, is a good deal, as long as you're below the estate tax threshold. If you're above the estate tax threshold, it no longer is a good deal. Yeah, you avoid the marginal capital gains tax, but instead of a 20 or 25% capital gains tax, now you have a 40 or 45%, or even sometimes 50 or 55%, depending on how big exactly, estate tax. So we have a client recently that we worked with that is way over the estate tax threshold, has children but no grandchildren, and we actually use that split interest gift structure to guarantee generation two a substantial income for the rest of their life, to completely zero out the estate taxes. Estate taxes will be zero. And when the children go, because there are no grandchildren, then there will be a charitable legacy that will be funded at that time. So there are some, and by the way, they've been doing 1031 exchanges for decades. So sometimes people do these 1031 exchanges and they work awesome. They're a beautiful thing. We like them. But what happens when you want to get out, and death is not the most attractive option? Sometimes the CRT is a way out. The installment sale, that's a really interesting concept. And in general, installment sales allow you to spread out the tax consequences of that gain. So when you sell property on an installment sale, you don't realize the gain all at once. You realize the gain essentially as you get it. So the most common way historically this has been done is to have a note, and seller financed. So the buyer buys the property and they pay you on this installment note over time, and you realize the gain as you get it. So when you have the seller financed note and they make a payment to you on that note, the payment's going to be part interest and part principal. The interest part's going to be ordinary income. The principal part is going to be two pieces. There will be the return of cost. That's tax-free because you're just getting your cost basis back. And then the gain is going to come in, and you're going to pay taxes on that gain at the gain rate. Now, because not every seller wants to be seller financing, they want the cash now, or they want the benefits of the cash now. There are some devices for using an intermediary that can do the installment sale and get the installment benefits of spreading out the deferral or spreading out the realization of the tax gain, but giving immediate investment benefits to the proceeds of sale. And that's sometimes called a deferred sale trust. There's some other acronyms out there for it. But that's a device. And so those are tools that we'll talk about. And sometimes, and this is interesting, sometimes when we look at it, people just say, you know what, I'm just going to pay my taxes. It stinks, it hurts, I don't like it, but that's what I'm going to do. And then also a very common thing is it doesn't have to be all one or the other. We can split it up. More than once, we've had clients that have said, well, I want to do partly a split interest gift, and I'm going to create that deduction that will offset enough income that I'll still pay some taxes, but not as much as I was going to. So I get some money right now that I can do whatever the heck I want to with it. Then I get some of the income through the split interest gift, and they kind of get the best of both worlds.
You mentioned as part of the 1031 exchange that there's a 45-day period where you have to identify a property, and then I think the other time limitation is 180 days where they have to actually make the transaction, make a successful transaction. So in the event that they are unable to meet those requirements for a 1031 exchange, would you comment on whether, is the charitable remainder trust, is that a good alternative if the 1031 exchange doesn't work out, or is the installment note still available if the 1031 exchange doesn't work for some reason? Can you still?
Great question. So the bottom line, the charitable option is off the table at that point. For the charitable split interest gift to work, that has to be in place and funded before there is a hard sales agreement. So if you've got even if you've got a sales contract, technically you can't do it. Now you can have, okay, we've been talking, we've got some ideas in principle, but nothing is binding or contractually committed. We can do the charitable gift. But once we're down that far down the road, we tried to do the 1031 and it blew up, we can't go back. Well, let me say this. I guess you can do the CRT, but here's what you don't get. You don't avoid the gain. You're going to realize the gain, and then you will get a modest tax deduction that will help you offset it. But the gain realization event by that point has occurred. It's water under the bridge. We can't go back and undo that. Now, the installment note, on the other hand, as long as we're in the same tax year, the transaction can generally be reformed and converted. Instead of doing a 1031, go to Plan B, and it can be reformed into an installment sale. That can run into issues if you cross a tax year, but that can be a bailout. And sometimes that's driven by the market. We see people who say, yeah, I'm going to do a 1031, and then they go out and look for a replacement property, and like right now, the market's just crazy. There's nothing for sale, or everything that's for sale feels like it's overpriced, or can't find a property that's suitable or that meets the criteria that the client's looking for. So sometimes, we give it a shot to do the 1031, and then it blows up. Doesn't work for one reason or another, and then that installment sale can be an option, can be an alternative.
Mm-hmm. You also mentioned this idea of replacement life insurance earlier in talking about the charitable remainder trust. And I was just wondering, is there ever a time where that scenario kind of blows up in people's faces when they try and replace, when they try and do this replacement life insurance?
Well, that's
Do
an
you have
interesting
any
question.
examples?
Yeah, so typically when we're doing that replacement life insurance, we're going to have an irrevocable life insurance trust, and if you come through our law firm, it'll be an irrevocable dynasty life insurance trust, which has some significant benefits in my opinion. But we own the life insurance there so that it's out of the taxable estate, and this is how people screw this up. They buy the life insurance personally, and if you own the life insurance personally, and you think, well, I don't get the death benefit while I'm alive. I only get the death benefit when I'm dead, so I don't get taxed on it. And then there's a red buzzer. Wrong. You do. This is one of the funky things that is not counterintuitive and people don't get. Death benefit of life insurance is included in your taxable estate. For it not to be included in the taxable estate, you can't own the policy and you can't be the beneficiary. So the policy needs to be owned by somebody, not you, and the beneficiary needs to be somebody, not you. So we create these irrevocable life insurance trusts for the benefit of children typically, and that's where we buy the life insurance. So people blow it up when they buy the life insurance personally, and then there's other rules, 3-year rules and gifting rules that kick in that make it complicated. Another way that it blows up is people come into this thinking, okay, I'm going to replace the gift I'm making to charity when I die with life insurance. And then they find out, well, daddy has some kind of medical condition and he's not insurable, or the insurance is ridiculously expensive because of age or a medical condition of some kind. And that can blow it up. So sometimes in that scenario, we look for an alternative person to insure. Well, if daddy's uninsurable, can we insure mommy? Can we insure second to die, a survivorship product? Mommy and daddy both, and the benefit doesn't pay until they've both passed. Or in extreme cases, can we even insure one or more of the children? That doesn't create a death benefit immediately when mommy and daddy pass, but it does create that tax-free death benefit eventually. And particularly in ultra high net worth situations or scenarios where the kids are doing okay, the children are going to be fine. What we're really trying to do is create a generation 3 wealth. Then sometimes it works to ensure the children instead of mommy or daddy. So there are issues with the life insurance. The other thing that comes up, I guess, is sometimes people have just a reptilian response to giving to charity and to life insurance. They go, "What, are you kidding? To get that tax advantage, I have to give something to charity and I have to buy life insurance? I don't care how good it is. I won't do that." And we encounter that. It's kind of like, this is my comparison, a big bowl of ice cream and a fresh chocolate chip cookie. Now, I'm sorry, that's delicious. But there are some people, for whatever reason, maybe it's health, maybe, they're trying to lose weight or whatever. They'll go, nah, I don't care how delicious it is. I'm not eating that. And if you've ever had teenagers, I have teenagers that are food picky. They go, I don't care if that's good, Dad. I'm not touching that. Okay, well, whatever. I'm going to have some. It's delicious to me. So sometimes those tax benefits aren't good enough for people to get over that, that nasty thing they have to swallow, the life insurance and the giving to charity. So if that's the case, great. And it's bizarrely, I've had clients go, yeah, I love this. And we get clear through the planning process and they spend money and they get lots of professionals working on this. And then we get right up to the point where, okay, all I need is a signature right there. Just sign that line and we're golden. It's all going to come together. And they'll go, no, I just can't do it. I guess it's like, at the altar, the bride runs away and says, "No, I'm not going to marry that guy." Sometimes people just, at the very final point of decision, they just can't do it. So sometimes those blow up, and then they pay the taxes.
Well, the example that you gave of earlier of converting idle non-productive assets into cash flow and deductions, I think you had used a story about a farmer and using some of the land that had orange trees on it or a grove. Have you had any other scenarios where maybe it's not an orange grove that might help people identify what could be other non-productive assets that could maybe trigger their thinking a little bit?
Yeah, and I appreciate the way you framed that question. People like me, I might lose a $20 bill. I use it as a bookmark in a book, and I put the book on the shelf and I forget about it. And a year later, I find, oh, hey, $20. Well, some people that have enough money do that with really expensive things. They'll have oh yeah, there's that 40 acres we own in New Mexico that we were going to build something on, and then we didn't. And it's been sitting there for a long time, and we keep paying the property taxes on it, but nobody wants it. We're not going to do anything with it. But it's a pain in the neck to sell. And oh, by the way, it went way up in value, and now we have capital gains tax on it. So we just don't want to do anything with it. So particularly ultra high net worth people or high income people, for whatever reason, tend to accumulate unproductive assets that they just have. They're hanging on to them, and they don't want to sell them because it's a pain in the neck, or because, again, there's some tax hair on it of some kind. And those kind of assets actually are really awesome to use for planned giving. You don't want it anyway. Would you like the income? Would you like a tax deduction? Sometimes we can even structure that either through the gift annuity or even with a carefully structured charitable remainder trust. We can make it so that income stream is deferred. So, and this is especially true with non-income producing assets. We can put it in that CRT, and you get the tax deduction today, yay! And then when it's gonna pop down the road, we can have trigger at retirement or sale of another asset or something that suddenly now the income stream from that charitable remainder trust kicks in. So we can turn those non-productive assets into assets that fund retirement, assets that pay for children's college education. We can do all kinds of clever things with charitable giving, and we've seen. I've seen people do that with we had a client do it with a race car. We had a client do it with a convenience store, and we had to structure some things to make that work so we didn't step on any tax landmines. But idle real estate is one. Oh yeah, I own this lot in Sedona, and I don't know why I have it. I was going to build a cabin there, but now I'm not. And so, okay, let's turn that into something useful. And it's the odds and ends. Let me tell you this story. I was actually giving a presentation about this kind of planned giving for another charity, and this charity told me, okay, we've invited some of our big donors here because we want them to hear about this, so that hopefully they're going to give us something. He said, but on the front row, there's going to be these two little old ladies. And I'm sorry, this is probably politically incorrect for me to describe this. The guy described them as these two blue-haired little old ladies. And he said, they are poor. He says, the only reason we invite them is because we love them. And every year they send us $20. He says, we invite them to these activities because they come and they enjoy the refreshments. He says, so whatever you do, don't talk to them. Leave them alone. I said, okay. So we were talking about doing this planned giving and selling a highly appreciated asset. And in the middle of my presentation, one of these ladies raises her hands and says, so would this work with a gas station? I said, well, potentially, yes. And she said, well, would it work with 7 gas stations? And I said, yes. And she said, well, my sister and I, we own 7 gas stations, and we have been afraid to sell them because we didn't want to trigger the capital gains tax. As it turns out, these two women were in fact extremely wealthy and had been hiding their wealth from this charity because they didn't want to have them asking for more money. And as it played out, we ended up crafting a solution for them that helped them solve a significant tax issue, that helped them diversify their assets, that helped them do some estate planning and take care of their family members. And in the process, the charity that had invited me to speak ended up getting some pretty significant benefits. So, yeah, we've seen all kinds of things. Sometimes productive or non-productive assets. We can do fun things with this planned giving.
Yeah, that's a neat story. That's one I haven't heard yet. So.
I can still surprise you with stories you haven't heard. That's cool. I want to talk about IRAs, and then we need to be wrapping up here. So let's hit on another kind of a clever planned giving thing that involves charitable giving, is with an overfunded IRA. And I hope, did I interrupt another question? Or are you good with that?
No, that's great. Yeah.
Okay. So here's what an overfunded IRA is. IRAs are designed to pay for what's that R for? What's that R in the middle word there? R, that's retirement. Retirement for who? For an individual. So that retirement income, that's your share. And then there's this other big chunk of an IRA. And by IRAs, by the way, I mean 401ks and all those retirement plan kind of things out there. There's a big chunk of that is not yours. It belongs to the federal government. And here's where I come at with that. I was once in a seminar with a couple of hundred other lawyers and some CPAs, and we heard an economist speaking, and somebody asked him about the national debt. And his take on it was, well, I'm not worried about the national debt because it's a complete fiction, which surprised the audience. And when questioned why, he said, well, because the federal government has an enormous amount of what he called off-balance sheet assets. And when pressed for more details, he came out and said, well, yeah, it's all these retirement accounts. And he had the numbers, which we don't have today. But he said, oh, these retirement accounts have this huge, gigantic tax that's ultimately going to be paid as people take the money out of their retirement accounts. And he went on to say, the clever thing is people think it's theirs. So they are very careful to invest it wisely and make it grow as big as possible because they think it's theirs. But the effect of that is it just increases the ultimate tax liability that's going to be paid. So those off-balance assets go to taxes. And there's going to be income taxes. If your estate's big enough, state taxes, there can have excise taxes depending on when you take it. And who wants to pay that tax? Who's excited about paying that tax? Anybody like that tax? Anybody just think, yeah, I got to pay taxes, hooray, cool, score. Even if you're of a political persuasion that you believe taxes are healthy and viable and important, it's been my experience that people who believe in taxes still hate paying them. So there's a private contractual alternative to that we're going to talk about here, and some cool things you can do with that overfunded IRA. So here's an IRA is overfunded if it has more money in it than you are going to use for your retirement or for your spouse's retirement. So a lot of people don't know this. There's a variety of organizations which are tax exempt. Churches are under, and those are the federal code, and certain organizations, the 501c organizations. Well, what's the 101 and the 7702 organization? What's that? That's tax exempt. Most people don't know what that is, and I'm just going to say this again. This is this nasty word over here. That exemption is life insurance. And I made the point there on that last slide that I skipped past it. All your IRAs, with the exception of Roth IRAs, your traditional IRAs and 401ks are not tax-free. People sometimes say, oh, that's tax-free. No, it's tax-deferred. So life insurance is a huge alternative to this. And I want to illustrate how this can specifically be used with an IRA, with an overfunded IRA, an IRA that has more in it than you're going to use. And I ask people, because I encounter these all the time. In fact, it was like last week we came up on a client, they're actually not a client, a potential client, with $8 million in an IRA, $8 million. And he's mad because he's He's had a birthday, and he's going to be required to take minimum distributions out of the IRA, and he doesn't need the money. He goes, I don't want the money. I don't want to pay the taxes on it. And we asked him, well, what do you want to do with that $8 million in the IRA? And he says, well, that's for my kids. And we had a little get religion conversation with him. Well, do you know how much of that your children are actually going to get? And by the time we went through his particular tax scenario, it was a small fraction because of the income taxes and the estate taxes. So here's this plan that's a planned giving solution that allows you to get out of these overfunded IRAs. And the first thing you do is you take the money while you're alive during your retirement and have a good time. Take it out, spend it, enjoy it. The more you get out, the better. And that money you take out while you're alive, you can give some to your heirs. And I'm going to suggest specifically that you form one of those dynasty irrevocable trusts that we talked about, and you gift the extra money to that irrevocable trust. And then you're going to do something very significant with it. You're going to buy what? Life insurance. Why? Because it's one of the 3 tax exempt forms of wealth. Churches, most people can't be a church. 501c3s, we've talked about family foundations. You want to come in under those where you can, but that's still not going to be for you. Life insurance is the only tax exempt thing that you get. So we're going to have you buy that tax exempt life insurance in that dynasty trust. And then what happens when you die? First of all, your children are going to get all that all that cash from the life insurance in the dynasty trust, tax-free, income tax-free, estate tax-free, which is really cool. And there's a whole nother discussion about how the dynasty trust works so it can protect and preserve the assets for multiple generations. But then what do you do with that IRA? Where does it go? Well, the best thing to do is have that IRA go to your family foundation. And interestingly enough, if you give your IRA money to your advised fund while you're alive, you don't get the deduction. That stinks. But if you give it to them when you're dead, if you make your family foundation the beneficiary of your IRA, dollar for dollar, it all goes to the foundation and your tax liability is 0. So what did we accomplish by this disinherit the IRS exit strategy out of IRAs, out of an overfunded IRA? We paid for your retirement handsomely. We took care of your heirs with tax-free money. We reduced your taxes at death on that IRA to 0. Your children got tax-free money, the tax-free money equivalent of what you had in your IRA. And instead of handing over all that IRA money to the politicians for them to decide what to do with it, it goes to your family foundation, and you and your family can decide what to do with it. So here's something for you to consider. And this is significant. And this is one of the reasons why planned giving comes in. And this can kind of be our concluding thought here, unless we have more brilliant questions. Michael, you'll probably have something you want to ask me. But here's the deal. Somebody's going to decide what happens with your wealth. Somebody is. And it can be you, or it can be the politicians. Now, who's going to be better at deciding what should happen with your money? You or the politicians? And even if you're of a political persuasion that you believe that politicians are always wise and never do anything nefarious or bad with your money, and if you give them their money, if you let them take your money, well, they're not going to take your money. They're going to take money from the other people. So if you let the politicians take other people's money, don't worry, they'll give you some and they'll take good care of you, and there will never be anything but the best of outcomes from that. Even if you believe that, would you like to participate in choosing how the money gets used? And with planned giving, one of the significant points of that is you are controlling who gets to make the choices. With planned giving, you choose. And you choose to employ the tax laws to your benefit, to the benefit of your family, to the benefit of the charitable causes and social causes that you believe in, instead of handing over that decision-making power to the politicians. So that's a big part of what drives planned giving. People come into it for tax reasons. People come into it because they're noble-hearted and good souls that just want to make the world a better place, which is all awesome. But it also comes down to who's going to make the decisions. You want to make those decisions, or do you want to let the politicians make the decisions? So, Michael, where are you at? You got any more questions for me, or are we going to wrap it up here?
Well, you've answered a lot of questions, Rick. So I don't have any other questions. I just I want to express appreciation for your responding to my questions and being very thorough and responding and letting us know more about planned giving and helping those who have watched and will watch this webinar to understand a little bit more about what they can do in the event that they are in situations like the ones we've talked about today and can either take the route of a charitable remainder trust or do a charitable gift annuity. If they don't want to do those, they have the 1031 exchange or the installment note to think about. And I think we've given people some good options today and to think about at least, and maybe to also tell their friends. So I'm pleased and appreciate the chance to be here with you.
Yes, and I want to give again a shout out and a thanks to our various sponsors and the people that tune in and listen. It's great to have you. We're available. The happiest and best part of my day is when I get to talk with people and get to address their concerns. So please give us a call or email us and let us know. It's a happy thing for us to be able to help in these kind of deals.
Yeah, we have, let's see, just to, I'll bring up our numbers here, and there's the emails. Normally we'll run those during the program, but those are some of the ways that you can get a hold of us. And certainly glad to answer any follow-up questions that any of you may have from the webinar today. And I don't have anything else, Rick. Is there anything else that you want to say?
We're signing off. Hit the exit music.
All right. I just need to find it here.